Welcome to our deep dive into corporate venture capital in the energy sector. In this video, we'll explore what corporate venture capital, or CVC, is, how it differs from traditional venture capital, and why it's becoming an indispensable tool for driving innovation and sustainability in the energy industry. CVC involves direct investments by corporations into external startup companies. Unlike traditional VCs, which primarily seek financial returns, CVCs often have strategic objectives, aiming to gain access to new technologies, markets, or business models that align with their core business. The energy sector is undergoing a massive transformation, driven by the need for decarbonization, digitalization, and decentralization. This rapid evolution demands continuous innovation, which traditional R&D alone can't always provide. This is where CVCs step in, acting as crucial catalysts for change. For established energy corporations, CVC offers a multitude of benefits that extend beyond financial returns. Firstly, CVC provides corporations with early access to cutting-edge technologies and disruptive business models. By investing in startups, companies can scout emerging trends, test new solutions, and integrate innovative approaches into their existing operations, staying ahead of the curve. Secondly, CVC fosters strategic partnerships and diversifies corporate portfolios. These investments can lead to collaborations that open new revenue streams, expand market reach, and mitigate risks by exploring areas outside their traditional scope, particularly in renewable and clean energy. It's not a one-way street. Startups in the energy sector also gain significant advantages by partnering with CVCs. The most apparent benefit is access to capital. Beyond funding, startups can leverage the vast resources of the parent corporation, including distribution channels, manufacturing capabilities, and extensive industry expertise. This support can significantly accelerate their growth and market penetration. Furthermore, CVC investments often come with the potential for strategic acquisition or long-term partnership. For a startup, being acquired by a major energy player can provide a stable future, while a partnership can offer validation and a pathway to widespread adoption of their technology. While the benefits are compelling, CVC in energy is not without its challenges and considerations. One significant hurdle is navigating corporate bureaucracy. Startups thrive on agility, and large corporate structures can sometimes slow down decision-making. Balancing the need for strategic returns with the financial objectives of the CVC arm can also be complex. Another key consideration is ensuring clear exit strategies for both the corporation and the startup. Whether it's an IPO, an acquisition by the parent company, or a sale to a third party, having a well-defined exit path is crucial for maximizing investment value and ensuring the startup's continued success. Let's look at some successful examples of CVC in the energy sector to illustrate these points. Major energy companies like BP, Shell, and Total Energies have established dedicated CVC arms, such as BP Ventures, Shell Ventures, and Total Energies Ventures. These entities actively invest in a diverse portfolio of startups, focusing on renewables, energy storage, carbon capture, and digital energy solutions. For instance, Shell Ventures has invested in companies like GlassPoint Solar, which provides solar thermal energy for enhanced oil recovery, and Sense, a home energy monitoring system. BP Ventures has supported startups in areas like EV charging, free-wire technologies, and advanced biofuels. These investments highlight the strategic intent to integrate new technologies and explore sustainable pathways. What does the future hold for CVC in the energy sector? The trends shaping CVC in energy are clear: an increasing focus on deep tech, greater collaboration between CVCs and traditional VCs, and a stronger emphasis on ESG, environmental, social, and governance factors. The push towards net zero emissions will only intensify the need for groundbreaking solutions. We predict continued growth in CVC investments in clean energy technologies, digital energy management, and sustainable infrastructure. As the energy transition accelerates, CVCs will play an even more critical role in bridging the gap between innovative startups and established energy giants, driving the industry towards a sustainable future. In conclusion, corporate venture capital is not just a financial tool, but a strategic imperative for the energy sector. It's a powerful mechanism for fostering innovation, facilitating strategic partnerships, and accelerating the transition to a cleaner, more sustainable energy future. Thank you for watching.